We're taught that money is all about numbers, spreadsheets, formulas, and logic. But money is also deeply emotional, shaped by our hopes, fears, and experiences. Our financial choices aren't just calculations. They're stories we tell ourselves about safety, success, and happiness. To truly understand money, we must look beyond the numbers, into the human heart. In The Psychology of Money, Morgan Housel shows that our behavior with money matters more than intelligence. It's not about what you know, but what you do. Habits, patience, and discipline shape financial success. True wealth is built on daily choices, not just knowledge. Let's explore how behavior drives lasting financial freedom. One of the most liberating ideas in financial thinking is the acknowledgement that personal finance is inherently personal. There is no single, one-size-fits-all formula for success. The investment strategy that works wonders for a young, single-tech entrepreneur with a high-risk tolerance would likely be a disastrously stressful path for a retired couple seeking stability and income. Their goals are different, their timelines are different, and most importantly, their emotional capacity to handle market swings is different. What one person views as an exciting opportunity, another sees as a terrifying risk. These differences are not flaws, they are fundamental aspects of our unique human experience. This means we must give ourselves permission to deviate from what is considered perfectly rational on paper. A financial advisor might prove with intricate models that putting every spare dollar into the stock market will yield the highest mathematical return over 30 years. This is a rational approach. However, if holding zero cash makes you so anxious that you lie awake at night, worried about a potential job loss or an unexpected medical bill, you are far more likely to panic and sell your investments at the worst possible time. In this case, the optimal strategy becomes the most destructive one because it fails to account for your emotional needs. A more effective approach is to be reasonable rather than purely rational. A reasonable plan is one that you can comfortably stick with through good times and bad. It might mean holding more cash than is mathematically optimal, simply for the peace of mind it provides. It might mean choosing a simpler, slightly less aggressive investment portfolio, because you understand it better and are less likely to abandon it in a panic. The best financial plan is not the one with the highest potential returns, it is the one that lets you sleep at night and allows you to stay the course for decades. It is a plan that is sustainable for you, the individual. This principle empowers us to stop judging our financial choices against an imaginary, perfect standard, and instead measure them by how well they serve our own lives and well-being. It encourages us to build a financial strategy that aligns with our personality, our fears, and our definition of a good life. It is about creating a system that works for you, not against you. Understanding this distinction is the first step toward building a relationship with money that is not only effective, but also peaceful and enduring, free from the stress of trying to be someone you are not. The pursuit of wealth is an internal journey. True wealth isn't about luxury cars or status, but the freedom to control your time and choices. It's the assets quietly compounding, the ability to walk away from what doesn't serve you, and the contentment found in enough. Let's explore how money can serve your happiness. In our modern world, we are conditioned to equate wealth with visible displays of spending. We see the influencer with the private jet, the neighbor with the brand new luxury car, or the friend with the expensive designer handbag, and we instinctively think, they must be rich. Our society has created a powerful narrative that links financial success directly to a person's ability to purchase extravagant things. This assumption, however, is one of the most fundamental misunderstandings in personal finance. Spending money to show people how much money you have is the fastest way to have less money. It is a performance, a fleeting illusion of prosperity that often masks an underlying financial fragility. True wealth is not what you see, it is what you don't see. It is the car that was not bought, the first-class upgrade that was declined, the designer watch that remains in the store window. Real wealth is the quiet accumulation of assets that are not converted into flashy liabilities. It is the money in your savings and investment accounts, working silently for you behind the scenes, compounding day after day. This kind of wealth is invisible to the outside world. It doesn't scream for attention or seek validation from others. Its value is not in what it can buy today, but in the options and freedom it provides for tomorrow. This distinction is critical because it forces us to redefine our financial aspirations. If our goal is to look rich, we will inevitably fall into a cycle of lifestyle inflation, where every increase in income is met with an equal or greater increase in spending. It is a treadmill that leads to stress and dependence, not freedom. However, if our goal is to be wealthy, our focus shifts from spending to saving and investing. We begin to derive satisfaction not from the things we acquire, but from the growth of our net worth and the security it represents. This internal shift is the first step toward building an enduring financial foundation. Therefore, we must learn to separate the idea of being rich from the act of looking rich. The former is about building financial independence and resilience, while the latter is often a social signal that comes at the cost of that independence. When you see someone driving a $100,000 car, the only data point you have for sure is that they have $100,000 less than they did before they bought it. Or more likely, they have a significant new debt. True wealth is hidden, and its reward is not admiration from strangers, but the profound and personal gift of controlling your own time. Warren Buffett's fortune isn't just about skill, it's about time and the quiet power of compounding. He started young and let his investments grow for decades. Compounding works like a snowball, slow at first, then unstoppable. The real magic happens over long horizons. Be patient, stay invested, and let compounding quietly build your wealth. In the world of finance, getting rich and staying rich are two entirely different skills, governed by opposing mindsets. Getting rich often requires taking risks. It demands optimism, a willingness to embrace uncertainty, and the courage to make bold bets on a future that you believe will be better than the present. It is the mindset of the entrepreneur who pours their life savings into a new venture, or the investor who concentrates their capital into a few high-growth stocks. This offensive strategy is focused on growth and accumulation. It is about maximizing gains and capturing opportunities. Many people are good at this part of the equation. However, staying rich is a different game altogether. It is a defensive strategy that requires an entirely different set of psychological muscles. While getting rich requires optimism, staying rich requires a degree of paranoia and humility. It is the recognition that the same risk-taking that built your wealth can also be the thing that destroys it. Staying rich is about survival. It is about understanding that fortunes can be lost much faster than they are made. This requires a shift from focusing only on potential gains to obsessing over the potential for irreversible loss. It is about appreciating the power of compounding and knowing that the worst thing you can do is get knocked out of the game entirely. The financial graveyards are filled with people who were brilliant at getting rich but terrible at staying rich. They flew too close to the sun, took on too much leverage, or failed to appreciate when it was time to shift from aggressive offense to prudent defense. A single mistake, a single moment of hubris or greed, can wipe out a lifetime of hard-earned gains. This is why humility is the most important trait for long-term financial success. It is the understanding that you cannot predict the future, and that you must protect yourself from the things you cannot foresee. It is about ensuring your own survival above all else. The practical application of this principle is to build a margin of safety into your financial life. It means avoiding excessive debt that could wipe you out in a downturn. It means diversifying your investments so that the failure of any single one does not ruin you. It means holding enough cash to weather unexpected storms without being forced to sell your long-term assets at the worst possible time. Getting rich is exciting and grabs headlines. Staying rich is quiet, often boring, and requires a discipline that is far rarer. It is the art of survival, and in the long run, survival is what matters most. We often think money is for buying things, cars, houses, vacations, but what we truly seek is freedom. The ability to control our own time, to choose how we live each day. The real power of money is not in what it buys, but in the autonomy it gives us. That is true wealth. In finance, we're told to be rational, cold, logical, and data-driven. But we're not robots, we're emotional, and our plans must reflect that. A reasonable plan is one you can actually stick with even when markets crash or fear takes over. The best plan isn't perfect on paper, it's the one you'll follow for life. Be reasonable, and you'll endure. Many investors dream of capturing all the upside of the market with none of the downside. But this is a fantasy. There is no such thing as a free lunch in investing. The incredible long-term returns the market offers come with a price: volatility, fear, and uncertainty. This is the cost of admission to compounding wealth. The fee isn't paid in dollars, but in emotional fortitude and patience. Remember, nothing worthwhile is free. Pay the fee, and you will reap the reward. We're often told to save for specific things: a house, a car, a vacation. But the most powerful reason to save is for the unknown. Think of saving as buying yourself flexibility and resilience. Life is unpredictable. Emergencies and opportunities appear without warning. A savings fund with no set purpose is your buffer against chaos, your ticket to peace of mind and freedom. Build a cash reserve for the unexpected. It's not idle, it's working to keep you strong, adaptable, and ready for whatever comes next. We love to credit success to hard work and blame failure on poor choices, but luck and risk shape every financial story. Bill Gates's brilliance mattered, but so did the rare chance of attending a school with a computer in 1968. That's luck. Risk is the flip side. You can do everything right and still lose, like a business shuttered by a pandemic. Recognize luck and risk in your own journey. Be humble. Build a margin of safety, and focus on principles, not personalities. Most results in finance come from a handful of rare, extreme events, not from what happens most of the time. In venture capital, one big winner pays for dozens of failures. In investing, a few stocks drive most returns. You can't predict which rare events will matter, so diversify and stay patient. Position yourself to survive the bad and seize the good. Endure the ordinary so you're present for the extraordinary. That's how fortunes are made. It's tempting to copy others' financial moves, but everyone's playing a different game with different goals and histories. What works for your friend may be disastrous for you. Your age, risk tolerance, and life experience matter. Before taking advice, ask, what game are they playing? Is it the same as mine? The best plan is one tailored to your own life, values, and timeline. Look inward, not outward. Social media pressures us to spend for status. But true wealth isn't about impressing others, it's about independence. Chasing admiration with flashy purchases often leads to debt and less control over your life. Real wealth is the freedom to choose how you spend your time and live on your terms. Define your values, spend for your own happiness, and remember, Owning your time is the ultimate status symbol. Navigating the world of finance honestly requires a delicate balance between two seemingly contradictory mindsets: pessimism and optimism. On one hand, you must be a short-term pessimist, acknowledging that setbacks are not just possible, but inevitable. On the other hand, you must be a long-term optimist, believing that despite the inevitable disruptions, the arc of progress bends upward over time. Reconciling these two perspectives is really the key to building a resilient and successful financial life. This means you should save like a pessimist, but invest like an optimist. Each mindset serves a different but equally crucial purpose in your overall strategy. Saving like a pessimist means accepting that the future is likely to contain surprises, and many of them will be unpleasant. Recessions, job losses, market crashes, health emergencies, and unexpected repairs are not black swan events. They're normal parts of a human life. A pessimist expects these things to happen and prepares accordingly. This is where your savings come in. You build a robust emergency fund and maintain a healthy margin of safety in your financial life. Not because you think the world is ending, but because you know that disruptions are a regular occurrence. This cash buffer is your defense against the inevitable chaos, allowing you to weather storms without being forced into desperate measures. At the same time, you must invest like an optimist. This means having faith in the long-term power of human ingenuity, innovation, and the desire for progress. Over any meaningful time horizon, history has shown that markets go up, economies grow, companies create value, and solutions are found for the world's problems. This long-term upward trend is the engine of wealth creation. An optimist understands that while there will be terrifying downturns and periods of panic, the overall trajectory is positive. This belief is what allows you to put capital at risk in the stock market, knowing that you are investing in the collective potential of humanity to make things better over time. This dual approach creates a powerful and balanced financial plan. Your pessimistic savings protect you from being wiped out by short-term volatility and panic. They give you the staying power to remain in the game. Your optimistic investments, in turn, are what allow you to capture the incredible long-term growth that creates real wealth. You prepare for the worst in the short term, so you can position yourself to benefit from the best in the long term. This combination of prudence and faith allows you to navigate the uncertain path of finance with both resilience and conviction, ready for both the storms and the sunshine. Compounding is the most powerful force in finance, but its magic is slow and often feels invisible. The hardest part isn't the math, it's the patience to wait while your investments grow quietly year after year. The real gains come at the end, after decades of waiting. Trust the process, endure the wait, and let compounding work its quiet miracle. Humans are masters of adaptation, but this can trap us on the hedonic treadmill, always wanting more, never feeling like we have enough. As our wealth grows, so do our desires, shifting the goalposts further away. True financial skill is knowing when to step off, define your own enough, and enjoy what you have rather than chasing endless accumulation. No plan survives its first contact with reality. The real world is unpredictable, so a resilient financial plan builds in room for error, a margin of safety. Like engineers overbuilding bridges, we must save more, expect surprises, and leave a buffer. That's how you withstand life's storms and succeed long-term. Pessimism grabs our attention. It feels smarter and more urgent than optimism. Bad news is fast and dramatic, while progress is slow and quiet. But history shows optimism wins in the long run. Look past scary headlines. Invest in the future, and trust in the enduring power of human progress. Your financial life isn't just about numbers or theories, it's about the story you tell yourself about money. That story shapes every decision, from daily spending to long-term goals. The most empowering stories see money as a tool to buy freedom, time, and a life aligned with your values. Reflect on your beliefs. Are they helping you or holding you back? Craft a story that serves you and use money to live your best life. The most powerful force in investing isn't timing the market, it's time in the market. Compounding works its magic the longer you stay invested, turning even small early investments into something remarkable. Don't wait for the perfect moment. Start now, invest consistently, and let time do the heavy lifting. The best advantage you have is an early start. The foundation of building wealth is simple: spend less than you earn. Your savings rate, the gap between income and expenses, is the most important factor in your financial life. Every dollar saved accelerates your path to financial freedom and teaches you to live well on less. Focus on widening that gap, and you'll build lasting wealth, no matter your income. Lifestyle inflation is the subtle urge to spend more as you earn more. Each upgrade feels deserved, but over time it can trap you in a cycle, living paycheck to paycheck just with fancier things. Defend your freedom, save and invest a portion of every raise so your wealth and your choices grow with your income. Life is unpredictable. Emergencies, car repairs, medical bills, job loss can strike anytime. An emergency fund is your financial fire extinguisher, turning panic into patience. It protects your investments, keeps you from debt, and brings peace of mind. Build it before investing. Treat it as non-negotiable, your shield against chaos and a gift to your future self. Don't invest in what you don't understand. FOMO and hype can tempt you into risky trends, but the fastest way to lose money is to stray outside your circle of competence. Stick to simple, proven strategies you truly grasp, like diversified index funds, and ignore the noise. Simplicity and discipline win in the long run. In a world of endless comparison, defining what enough means to you is a financial superpower. There will always be someone with more, but true wealth is about living a life of freedom, security, and fulfillment, on your own terms. When you know your finish line, you can stop chasing more and start enjoying what matters most. That's how you truly win the game of money. As we reach the end of this exploration, it becomes clear that the psychology of money is not really about money at all. It's about us. It's about our deeply ingrained behaviors, our hidden biases, our unique histories, and the complex emotional stories we tell ourselves about what it means to be secure, successful, and happy. The numbers on a spreadsheet, the charts of market performance, and the intricate financial products are really just the external landscape. The real work, the journey that truly matters, takes place within our own minds. How we navigate this internal world is the ultimate determinant of our financial well-being and our life's contentment. We've learned that our behavior is the most powerful lever we can pull. It matters more than our intelligence, our salary, or even the sophistication of our investment strategy. Simple habits, practiced consistently over a lifetime, will always outperform brilliant but erratic actions. The person who saves a little from every paycheck, who lives below their means, and who patiently allows their investments to compound, will almost certainly end up in a better position than the genius who is constantly chasing the next big thing, driven by greed and fear. This is actually an empowering truth. It means that financial success is accessible to everyone, not just a select few with specialized knowledge. Your financial decisions are a mirror reflecting your deepest fears and your highest aspirations. Do you save out of a fear of scarcity, or do you save to purchase future freedom? Do you spend to project an image of success to others, or do you spend to genuinely enhance your own life? Understanding these motivations is the first step toward building a healthier relationship with money. It requires us to be honest with ourselves, to confront the anxieties and desires that operate just beneath the surface of our conscious thoughts. This self-awareness is really the foundation upon which a truly resilient and meaningful financial life is built. Ultimately, is an invitation to look inward. It encourages us to become students of our own behavior, to recognize our own unique emotional triggers, and to craft a financial plan that honors our humanity rather than fighting against it. It's not about finding the perfect rational answer. It's about finding the reasonable, sustainable path that works for you. This journey of self-discovery is the most valuable investment you will ever make, yielding returns that can't be measured in dollars, but in a life lived with greater intention, peace, and purpose. If there are two virtues that stand above all others on the path to financial well-being, they are patience and kindness. Patience is the master skill of compounding. It's the quiet discipline to stay the course through years of seemingly insignificant progress, trusting that the slow, steady process is working its magic beneath the surface. It's the emotional fortitude to do nothing when markets are in a panic, to resist the urge to act when inaction is actually the wisest move. Our world, with its demand for instant gratification and constant action, really doesn't teach or reward patience. Yet, in the realm of long-term investing, it's the indispensable ingredient for success. Kindness, particularly kindness to yourself, is the second pillar. The financial journey is long and you will inevitably make mistakes. You'll buy high and sell low at some point. You'll miss out on an investment that turns into a massive winner. You'll fall prey to a behavioral bias you thought you had conquered. In these moments, it's easy to fall into a cycle of regret and self-criticism. But harsh judgment is counterproductive. The ability to forgive yourself, to learn from your mistakes without being defined by them, and to simply keep moving forward is a form of emotional margin of safety. It's what allows you to stay in the game for the long haul. This gentle approach extends to how we view our progress. We must be kind enough to accept that a reasonable plan we can stick with is better than a perfect plan that causes us stress and anxiety. It means giving ourselves permission to hold more cash than is mathematically optimal if it helps us sleep at night. It means not berating ourselves for a small, frivolous purchase if it brings us genuine joy. A financial plan that is too rigid and unforgiving is brittle. It'll shatter under the first real pressure. A plan rooted in kindness and flexibility is resilient. It can bend without breaking, adapting to the messy reality of life. Therefore, as you build your financial life, be patient with your investments and be kind to yourself. Celebrate the small, consistent wins. Acknowledge that progress is slow and non-linear. Understand that the goal is not perfection, but persistence. This softer, more humane approach is not a sign of weakness. It's actually the ultimate source of strength. It creates a sustainable path that you can walk for a lifetime. One that leads not just to wealth but to a state of calm and enduring contentment, free from the harsh demands of unrealistic expectations. In the end, we must always return to the fundamental question, what is money for? It's not a scorecard to measure our worth against others. It's not an end in itself. Money is a tool. It's a resource whose sole purpose is to help us live a better, fuller, and more self-directed life. The ultimate goal of building wealth is not to have the ability to buy more things, but to have the ability to control your own time. This is the true prize. Freedom is the ultimate dividend, the highest return on investment that your money can ever provide. It is the ability to wake up in the morning and have choices. This perspective really changes everything. It reframes saving from an act of deprivation to an act of liberation. Every dollar you set aside is a down payment on your future autonomy. It reframes investing from a stressful game of beating the market to a calm, long-term project of building a foundation for your independence. When freedom is the goal, you become less concerned with the fleeting admiration of others and more focused on the quiet internal satisfaction of owning your own life. You begin to see that the most valuable things money can buy, security, flexibility, and time, have no price tag and are invisible to the outside world. As you move forward from this summary, carry this central idea with you. Build a financial life that serves your happiness, not your ego. Define what enough means to you, and find the courage to stop when you get there. Save like a pessimist so you can endure the inevitable storms, and invest like an optimist so you can capture the rewards of human progress. Be reasonable rather than purely rational, creating a plan that you can comfortably live with. And above all, remember that your behavior, your patience, and your kindness to yourself will determine your success far more than any external market condition. The psychology of money teaches us that the secret to wealth is to stop seeing it as a destination, and to start seeing it as a journey toward freedom. It's about crafting a life where your money serves you, not the other way around. The real goal isn't just to get rich in your bank account. The goal is to live a rich life, a life full of time for what matters, full of peace of mind, and full of the profound and quiet joy that comes from being truly free.